The money markets, of course, roiled the past couple of days by reports that Standard & Poor's and Moody's might downgrade Greece. What of Fitch, though? Well, for more on that, we're now joined by Brian Coulton, head of ratings for Europe, the Middle East, and Africa at Fitch. He's coming to us live from London. First question, Brian, is what do you think of Greece? What's the possibility of a ratings move from Fitch?
Well, Greek public finances have clearly deteriorated very sharply over the last year or so. We still have a negative outlook on the rating, but really what happens next depends on events. It's not a question of time, as suggested yesterday by some of the other agencies. It's a question of events, and next week is going to be crucially important. The government will be coming to the market to raise some debt, and we could have a significant announcement of further fiscal austerity measures, as the EU has suggested today.
Yeah, there have been reports that if you take apart the Greek budget, it doesn't actually meet the targets that have been set. What does Fitch think?
Well, when the budget was put together, the assumption was that the economy would shrink by about 0.25% this year, and made some assumptions on interest rates. So both those assumptions no longer look right, because the economy subsequently fell more than we thought in the final quarter of last year, and growth this year is going to be weaker. I think the Commission talking about -2% now, and obviously the market interest rates have gone up and are higher than what was assumed. So to get to the same target of 8.7, you're going to need more measures, and that's what the Commission have said. Well, there's rumours that the government are going to come up with some additional measures next week. But it's not just that; it's also that the measures previously set out, some of those were a little bit vague, like improving tax collection. Nobody could really get their hands around that. What the Commission's saying is you need much more concrete measures. They're talking about VAT. They're talking about fuel duty increases, wage cuts. Now, if we actually get those sorts of measures, I think that will actually be a significant strengthening of the Greek programme.
Got just a minute left. You wrote recently that the chances of the EU stepping in will depend on what they perceive the contagion risk to be. What does Fitch think the contagion risk is now for countries like Spain, Portugal?
Well, everyone's saying all these countries are in exactly the same boat. There's a problem with peripheral euro area. Well, if you actually look at the movements in the spreads, they've not really fitted with that story. It's been about countries with large fiscal deficits. That's why Spain and Portugal have been in the focus. It's not about a sort of fundamental competitiveness problem across the whole of the euro area. If that was the concern, then Italy would have sold off, and Italy hasn't sold off because their deficit has been narrow. So I think this argument, there's this savage contagion to other countries. Maybe if you look at the CDS market, but if you look at the cash market, it doesn't really pan out that way. It's really about fiscal policy, and the Spanish government have come up with a very strong plan to turn the budget around this year. The Portuguese less strong, but we hope that will be strengthened going forward.
All right, Brian Coulton from Fitch Ratings, thank you very much for joining us today.